Probably the biggest property myth of 2011 was the claim that Australia was in a property bubble that was about to burst. Hi, I'm Michael Yardney, and I just want to remind you that it was only a few years ago when doomsday economist Debunking predicted house prices would plummet. Awkwardly for him, average house prices went up 40% rather than down. Interestingly, now he predicts that house prices are going to fall around 5% this year. And I must admit that that's likely to be the case in some areas. Of course, last year, Harry Dent, another purveyor of doom, came to our shores, warning that the economic tsunami was about to hit. He suggested starting in Europe, there'd be a downturn that would spread to the United States, to China, and eventually to Australia. And he thought that would cause property prices to drop to levels not seen since the late 1990s. Now, he was right about the economic troubles much of the world faces. But I don't think he understands the fundamentals of Australian property. Now, I'm not suggesting we're immune to overseas problems. Clearly we're not. But I can't see a property crash here. Okay, well, what about all the discussion last year about affordability? Throughout the year there were cries that housing is unaffordable and something has to be done. The year finished off with The Economist magazine once again warning that Australian house prices would plunge. They thought by as much as 25% on the back of the global credit crunch. This isn't as bad as last year when they suggested our prices were 61% overvalued based on the house prices to rents. And only last week the Demographic International Housing Affordability Survey once again said that Australia exhibited the worst housing affordability of any nation outside Hong Kong. So is our property market really so overpriced, and is there a bubble waiting to burst? Well, the latest stats from RP Data and Australian Property Monitors suggested that we're moving into the next phase of our property cycle. The predictions of a property market crash just didn't eventuate last year. Not in our main capital cities anyway. Of course it did in some of our holiday locations like the Gold Coast and the Sunshine Coast. But they were never really areas to invest in, were they? Now, I know some property pessimists would argue that the bubble's just getting worse, getting bigger and bigger, which means it's really going to burst and we're heading for a property crash just like overseas. Is housing really unaffordable? Well, look, I agree many homes in Australia are expensive. Housing's generally expensive. But that's what comes from having large dwellings in some of the best spots in the world to live in. Let's face it, house prices did get a bit of ahead of themselves in some parts of Australia, and in part they've since corrected, especially in the more affluent areas and in holiday locations. But that doesn't mean that the property's unaffordable or that it's going to crash. Before I explain that a bit further, if you really want to get involved in property investment, or if you want to take it to the next level, I'd like to suggest you get a copy of my top-selling book. This has been a bestseller year after year. It's become the property investment classic, How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. If you want to understand the way that successful investors have gotten out of the rat race and developed financial independence, get your copy of How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. You can buy it online by clicking the link on this website and getting your own copy sent to you in the mail. Okay, getting back to affordability. Economist Christopher Joy gives the final word on house price affordability in an excellent article on the Property Update website. Others have suggested there's other ways of looking at affordability, that all those people overseas are looking at it wrong. A new study by the Australian Housing and Urban Research Institute strongly suggests that the traditional method of calculating housing affordability, that people have been using for a long time, is now outdated, and it should be considered in other ways, or with other things as well, weighing up whether people can afford their mortgages or not. You see, when you look at all these results that say we're unaffordable, the most commonly used benchmark to determine affordability is if housing costs less than 30% of household income. However, some households can afford to spend more than half their income on mortgages or rent, while others struggle when they spend 30% or even less of their gross earnings. You see, according to a paper from the United States Census Bureau, that rule that households can devote 30% of their income to accommodate costs before they're burdened, that actually evolved from the United States National Housing Act of 1937. Yes, it goes back that far when they decided 30% was the benchmark. Times have changed a lot since then. We live differently now. There are a lot more digs, dual income, no kids, sinks, single income, no kids, mingles, middle-aged singles. There's a lot more one-person households. Life is different. So how else could you look at affordability? Property commentator Michael Matusik suggested instead you should probably look at income that's left over after debt servicing, because this approach paints a very different picture to that obtained simply by calculating the portion of income devoted to repayments. Matusik suggested rising incomes have allowed households to meet rising loan repayments while maintaining and often increasing living standards. Michael Matusik believes that rising household incomes means that the 30% traditional affordability benchmark is now outdated. See, a few people are saying that, aren't they? In fact, given higher income levels now, households can devote as much as half of their income to debt servicing while maintaining the same standard of living. Now, I mentioned a short while ago this study by the Australian Housing Research Institute. It found similar results. Now, don't get me wrong, I'm not saying that some people are not suffering mortgage stress. What I am saying, though, is that some households can easily afford 50-60% of the income going on rents or mortgages and still have plenty left over. What it boils down to is that potential first home buyers need to understand that buying your first property isn't easy. It never was. It involves saving discipline. It involves sacrifice and compromise, and maybe moving into something smaller, maybe not as attractive as your ideal first home. Not first up anyway. Why don't I think the housing market's going to crash? Why was that big myth last year of a crash? Well, currently there's a tug of war that's affecting our property markets. It's got low interest rates pulling hard on one end, and at the other end there's all that economic uncertainty, joining forces with subdued prospects of economic, income and employment growth. And I expect the economic side of the equation to win out in the near term. In other words, that's going to dampen our enthusiasm, influenced by, in the first half in particular, by the global financial turbulence. What this means is that property values are likely to remain flat in most parts of Australia for the first half of the year. But our overall market is unlikely to collapse. For that to occur, you'd either have to have really, really high interest rates, or massive unemployment, or a recession, or a failure of our banking system. And I can't see any of these things happening in the foreseeable future. In the meantime, we'll see more US analysts surprised that Australian real estate hasn't collapsed, not like their markets have. The problem is that these economists keep analysing Australian properties as if they were shares. It's like comparing apples and oranges. Remember, in Australia, 70% of properties are bought by owner-occupiers. And one of the things that keeps pushing our property prices up is that, by and large, these property owners, these owner-occupiers, all want to live in the same areas. If you think about it, 70% of our population live in one of 8 big capital cities, and most of these people want to live in the same inner and middle ring suburbs near the city, near amenities, and near their jobs. Another reason we're not going to have the crash is that Australia doesn't have suburbs full of empty houses awaiting mortgage sales like in the United States. And despite our population growth falling lately, it's still growing faster, at a much faster rate than most developed nations. Now, sure, some Australians currently have issues with housing affordability, and others are putting off their home buying decision with the uncertainty. But people still need a roof over their heads. People are still getting married, they're getting divorced, they're having babies, they're moving houses, they're moving jobs. And if they can't afford to buy a house, they've got to rent one. And that's why, in general, our vacancy rates are at unprecedented lows, and they're pushing up rentals. I guess the bottom line is we're moving into the next stage of the property cycle, the stabilisation phase of the cycle. You see, the market doesn't move directly from the downturn phase to the property upturn. There's a period of time where buyers return and take up the slack before prices start rising. I expect to see more buyers return to the market this year when they realise prices aren't going to tumble. By the way, the stabilisation phase is a great time for savvy investors to get set for the upturn stage of the cycle. this year may be a good time to buy property. I've always found that it's a good time to buy when everybody else tells you maybe not such a good time. Now's the time for you to get set for the future. Over this year, I'm going to be giving you my thoughts on how to firstly protect your assets and then how to grow your wealth. I'm going to do this through this newsletter. I'm going to do it through my daily blog. Now, that's a different subscription to my fortnightly newsletter. So if you don't subscribe to my daily blog, you can do so by clicking a link on the website. The next way I'm going to do it is through a series of national property market update seminars that I'm going to be conducting around Australia in March and April in 5 states. I'm going to be sending you details of those soon. For a small group of you, I'm going to be working together with you, holding your hand, working closely together with you in my mentorship program, explaining to you the science of becoming wealthy. Now, the next intake opens soon, so you can find out all about the mentorship program at michaelyardney.com.au. The next intake is open already, and I'd really love you to join me. I really would like to work with you this year. It's only a small group I work with every year, but boy, have we had some great results. And then for an even smaller group of you, we're going to be seeing you at Wealth Retreat 2012. This is Australia's ultimate educational and networking event for property investors, for business people and entrepreneurs. If you're a serious level 3 or 4 investor, or you want to become one, put aside the last weekend in May in your diary, and a small group of investors who've already hopped out of the rat race and building their own portfolio are going to join you. You're going to join them, and you can check all this out at wealthretreat.com.au. Spend 5 days with the sharpest minds in property. Now, of course, I'm going to keep you up to date on how to take advantage of the changes happening in our property markets in future updates. You're going to get those on a regular basis from me. But it's probably appropriate to remind you that in changing times like we're experiencing, no one can help you quite like the independent property investment strategists at Metropole. I'm really proud of the results of our team. We won a whole heap of awards again last year. Top buyers agent, top property investment strategists, top finance brokers. But we've got no properties to sell, so the advice at Metropole is independent and unbiased. If you want to find out a bit more about what's happening in your local markets and what our research suggests in store, why don't you join us at a free property briefing in our offices in Melbourne, Sydney and Brisbane, or with our associates in Perth. Click on the link on the website and you're going to find out all about it. I'm actually looking forward to 2012. Are you? Look forward to seeing you in the next update real soon.